The importance of financial literacy in achieving freedom. Financial freedom is a goal that many aspire to but few truly achieve. It represents the ability to make life decisions without being overly burdened by financial constraints. Whether it's retiring early, traveling the world, or simply living comfortably without worrying about monthly expenses, financial freedom is an empowering state. However, achieving it requires more than just earning a high salary. It demands a solid understanding of financial literacy. Understanding financial literacy. Financial literacy is the ability to understand and effectively use various financial skills, including budgeting, investing, debt management, and retirement planning. It is the foundation upon which financial independence is built. Without financial literacy, individuals may struggle with money management, fall into debt traps, and miss out on opportunities to grow their wealth. In today's world, financial decisions are more complex than ever. Credit cards, student loans, mortgages, and investment options can be overwhelming without the right knowledge. Unfortunately, financial education is often not prioritized in traditional schooling, leaving many adults ill-equipped to manage their money effectively. The link between financial literacy and freedom. Achieving financial freedom requires making smart financial decisions consistently. Without financial literacy, people often make costly mistakes, such as accumulating excessive debt, living paycheck to paycheck, or failing to save for retirement. Here's how financial literacy plays a crucial role in attaining true financial freedom. 1. Effective budgeting and expense management. Budgeting is the first step toward financial stability. A well-structured budget allows individuals to allocate their income wisely, ensuring that essential expenses are covered while leaving room for savings and investments. Those who lack budgeting skills often find themselves struggling with financial instability. Understanding how to distinguish between needs and wants is crucial in maintaining a balanced budget. A financially literate person knows how to cut unnecessary expenses and prioritize financial goals. This ability to manage expenses wisely paves the way for greater financial freedom. 2. Avoiding debt traps. One of the biggest obstacles to financial freedom is debt. While some debts, such as mortgages or student loans, can be considered investments in the future, high-interest consumer debt, like credit card balances and payday loans, can be financially crippling. Financial literacy empowers individuals to make informed borrowing decisions. It helps them understand interest rates, repayment terms, and the long-term impact of debt. By avoiding unnecessary loans and managing existing debt effectively, individuals can free themselves from financial stress and focus on building wealth. 3. Building an emergency fund. Financial freedom is not just about wealth, it is also about security. Life is unpredictable, and emergencies such as medical expenses, job loss, or unexpected repairs can derail financial stability. A financially literate person understands the importance of an emergency fund. Having 3 to 6 months' worth of expenses saved in a readily accessible account can prevent individuals from falling into debt when unexpected situations arise. This financial cushion provides peace of mind and prevents setbacks on the journey to financial freedom. 4. Smart investing for wealth growth. Saving money is important, but investing is what accelerates financial growth. Inflation erodes the purchasing power of money over time, meaning that simply keeping savings in a bank account may not be enough to achieve financial freedom. Financial literacy includes understanding different investment vehicles such as stocks, bonds, mutual funds, and real estate. A financially educated person knows how to diversify investments, manage risks, and take advantage of compound interest. By making smart investment choices, individuals can grow their wealth and achieve financial independence faster. 5. Planning for retirement. One of the biggest financial goals for many people is to retire comfortably. However, without proper planning, retirement can be filled with financial struggles. Financial literacy helps individuals understand the importance of early retirement planning. It teaches them about retirement accounts such as 401ks, IRAs, and pension plans, and how to maximize contributions and employer benefits. The earlier one starts saving and investing for retirement, the more financially secure they will be in their later years. 6. Understanding taxes and maximizing savings. Taxes play a significant role in financial planning. Many people fail to take advantage of tax-saving strategies simply because they lack knowledge about tax laws and benefits. A financially literate person understands tax deductions, credits, and investment-related tax advantages. They can make informed decisions that minimize tax liabilities while maximizing savings. Efficient tax planning can significantly boost one's ability to accumulate wealth over time. 7. Developing financial discipline and mindset. Financial freedom is not just about knowledge, it also requires discipline and the right mindset. Many people struggle with impulsive spending, lifestyle inflation, and lack of financial planning. Financial literacy helps individuals develop better financial habits. It teaches delayed gratification, goal setting, and the importance of living below one's means. Financially disciplined individuals make decisions that align with their long-term financial goals rather than short-term desires. The consequences of financial illiteracy. The lack of financial literacy can lead to various negative outcomes, such as chronic debt. Without knowledge of interest rates and repayment strategies, people may fall into endless debt cycles. Financial stress. Living paycheck to paycheck and struggling to cover expenses can cause anxiety and reduce overall well-being. Missed opportunities. Many people miss out on investment opportunities simply because they don't understand how the stock market, real estate, or retirement accounts work. Dependence on others. Financially illiterate individuals may have to rely on family, government aid, or loans to survive, limiting their independence. How to improve financial literacy? The good news is that financial literacy is a skill that can be developed at any stage of life. Here are some ways to improve financial knowledge. Read books and articles on personal finance. Many bestsellers offer practical advice on budgeting, investing, and wealth building. Take online courses or attend financial workshops. Many free and paid courses teach essential financial skills. Follow financial experts and podcasts. Learning from successful investors and financial advisors can provide valuable insights. Use budgeting and investment tools. Apps like Mint and YNAB and investment platforms like Robinhood or Fidelity make financial management easier. Seek professional advice. Consulting a financial advisor can help individuals make informed financial decisions based on their personal circumstances. The role of financial literacy in economic stability. Beyond personal benefits, financial literacy also plays a crucial role in economic stability. When individuals make informed financial decisions, they contribute to a healthier economy. A population with strong financial knowledge is less likely to default on loans, fall into excessive debt, or rely heavily on government assistance. Instead, they are more likely to invest, start businesses, and create jobs, boosting overall economic growth. Governments and financial institutions must emphasize financial education to ensure that citizens are equipped to navigate complex financial systems. Moreover, financial literacy reduces the risk of financial crises. Economic downturns are often fueled by poor financial decisions at both individual and corporate levels. For instance, the 2008 financial crisis was partly caused by excessive borrowing and a lack of understanding of mortgage risks. Educating people about financial risks, responsible borrowing, and long-term financial planning can prevent such large-scale economic disruptions. Financial literacy is a lifelong journey. Achieving financial literacy is not a one-time event but a continuous learning process. As financial markets, tax laws, and investment opportunities evolve, individuals must stay updated to make informed decisions. The rise of digital currencies, fintech innovations, and new economic policies means that what works today may not be effective tomorrow. Individuals can adapt to changing economic conditions and ensure sustained financial freedom by committing to lifelong financial education. Whether through reading, attending seminars, or seeking professional guidance, consistently improving financial knowledge is one of the best investments anyone can make. With the right financial skills and mindset, achieving lasting financial independence becomes a possibility and a reality. Financial literacy is the key to unlocking financial freedom. It empowers individuals to manage their money, avoid financial pitfalls, and build a secure future. However, achieving long-term financial independence becomes difficult without a strong foundation in financial education. The journey to financial freedom starts with knowledge. By developing financial literacy, individuals can make smarter financial decisions, build wealth, and ultimately live life on their own terms. Whether it's learning how to budget, invest, or plan for retirement, improving financial literacy is an investment that pays lifelong dividends. Strategies for creating and maintaining a sustainable budget. Budgeting is one of the most essential aspects of managing your finances, whether for personal use, a household, or a business. A well-structured and sustainable budget can help you manage your money more efficiently, plan for the future, and ensure financial stability. Many people struggle to stick to a budget because they either set unrealistic expectations or fail to anticipate unexpected costs. A sustainable budget isn't just about cutting back on spending, it's about finding balance and making smarter financial decisions. It should be a plan that allows you to live within your means while also securing long-term goals. Define your financial goals. Every successful budgeting strategy starts with defining clear financial goals. When you know what you're working toward, it becomes much easier to prioritize your spending and make decisions that align with your long-term objectives. The first step is to think about your goals in both the short and long term. Are you looking to pay off debt, save for a major purchase, build an emergency fund, or plan for retirement? By having a clear picture of what you want to achieve, you can tailor your budget to help you reach these milestones. Financial goals can be divided into three categories. Short-term goals focus on achieving objectives within a year or less, like paying off a small credit card balance or saving for a vacation. Medium-term goals span from 1 to 5 years, such as buying a car, funding an education, or saving for a home down payment. Long-term goals typically take 5 years or more, like retirement planning, investing in real estate, or achieving financial independence. Once you've set your financial goals, break them down into smaller, manageable steps and assign timelines. This approach allows you to measure progress and maintain motivation throughout the process. Analyze your income and expenses. The next crucial step in creating a sustainable budget is understanding your current financial situation. You need to gain a clear picture of your income and expenses. Start by identifying all your sources of income, such as your salary, side hustles, freelance work, rental income, or any passive income from investments. This will provide the foundation for your budget and give you an idea of how much money you have to work with each month. Next, it's essential to track and categorize your expenses. Expenses can be divided into two categories: fixed and variable. Fixed expenses are those that don't change from month to month, like rent, mortgage, insurance premiums, and loan payments. These are non-negotiable and are necessary to keep your life functioning smoothly. On the other hand, variable expenses can fluctuate, such as groceries, utilities, entertainment, dining out, transportation, and shopping. These are the areas where you can make adjustments to align with your budget goals. Tracking your spending is a critical part of the budgeting process. Many people are surprised by how much they spend on discretionary items when they do a thorough analysis. Use tools like budgeting apps, spreadsheets, or even a pen and paper to record your expenses consistently. Once you understand where your money goes, you can begin identifying areas where you can cut back or optimize your spending. Differentiate between needs and wants. One of the most common reasons people overspend or fail to stick to a budget is confusing wants with needs. While both are part of daily life, understanding the difference is essential for creating a sustainable budget. Needs are the essential items you cannot live without, things like housing, food, healthcare, transportation, and basic utilities. These are the non-negotiable costs that must be factored into your budget. On the other hand, wants are non-essential items that enhance your lifestyle, like entertainment, dining out, designer clothing, or vacations. While these items may be enjoyable, they are not crucial to your basic survival. A practical approach is to focus most of your budget on covering your needs first, and then allocate a portion for your wants. A common budgeting strategy is the 50-30-20 rule. In this method, you allocate 50% of your budget for necessities, 30% for discretionary spending, wants, and 20% for savings and debt repayment. This approach helps you maintain a healthy balance between living comfortably now and planning for the future. Create a realistic and flexible budget. One of the biggest reasons people fail at budgeting is that they create an unrealistic budget that's too restrictive or too lenient. Creating a sustainable budget means making it realistic, so you can stick to it over the long term. Start by setting realistic expectations based on your current income and past spending patterns. Review your past few months of expenses and use that as a baseline to set your limits. A sustainable budget also needs to have flexibility built into it. Unexpected expenses are a normal part of life, and a rigid budget may cause stress when life doesn't go as planned. To prevent this, leave some room for flexibility in your budget for these unpredictable costs. For example, if your car breaks down, having a flexible budget that allows you to adjust other spending categories can help absorb that cost. Gradually adjusting to your financial reality can make budgeting easier to maintain. Drastic changes or drastic cuts may seem tempting, but they often lead to burnout. Instead, make small, incremental adjustments to your spending, which will allow you to adapt more effectively without feeling deprived. Automate savings and bill payments. An effective way to maintain your budget and avoid late fees is to automate your savings and bill payments. Automation helps remove the mental load of managing these tasks each month and ensures you don't forget essential payments. For savings, set up an automatic transfer to your savings or investment account each time you receive income. This ensures that you're prioritizing your future before you start spending. Treat your savings as a fixed expense and make it non-negotiable, just like your rent or utility bills. Even small amounts, when automated, can add up over time and help you reach your financial goals faster. Automating bill payments ensures that you never miss a due date and helps you avoid costly late fees. Most service providers, including credit cards, utilities, and loan companies, allow you to set up automatic payments. This ensures that your bills are paid on time, reducing stress and keeping your finances in order. Cut unnecessary expenses. Reducing unnecessary expenses is an essential component of a sustainable budget. While everyone has unique spending habits, there are areas where most people can cut back. This doesn't mean you have to eliminate all fun or discretionary spending, but it's important to evaluate where you can reduce without sacrificing quality of life. Look at your monthly spending and identify subscriptions, services, or purchases that you no longer use or need. Canceling unused gym memberships, streaming subscriptions, and magazine subscriptions can free up a significant amount of money each month. Similarly, dining out and ordering takeout can add up quickly, so cooking at home more often can help reduce unnecessary food costs. Energy efficiency is another area where you can cut expenses. By using energy-efficient appliances and reducing energy consumption, you can lower your utility bills significantly. Taking small steps to limit wasteful spending will help you stay within your budget without feeling deprived. Build an emergency fund. An emergency fund is crucial for maintaining financial stability. Unexpected expenses, like medical bills, car repairs, or home maintenance, can derail your budget if you don't have money set aside for these types of situations. Having an emergency fund helps you avoid going into debt when life throws a curveball. Start small by setting aside a few $100s for emergencies. Over time, aim to build your fund to cover 3 to 6 months of living expenses. This provides a financial cushion and reduces the likelihood of financial stress during difficult times. Keep your emergency fund in a separate, easily accessible account, like a high-yield savings account, where it's not too tempting to dip into for non-emergencies. Pay off debt efficiently. Debt repayment should be a priority when managing your budget. The longer you carry debt, especially high-interest debt like credit cards, the more it will eat into your finances and prevent you from achieving your goals. There are two popular strategies for paying off debt: the debt snowball method and the debt avalanche method. The debt snowball method involves paying off the smallest debt first, then moving to the next smallest, and so on. This method provides a psychological boost as you eliminate each debt. The debt avalanche method, on the other hand, focuses on paying off the debt with the highest interest rate first to save on interest costs. Either method works, and choosing the one that fits your personality and financial situation can help you stay committed to your debt repayment journey. Regularly review and adjust your budget. Your budget isn't a static document. Life changes, and so should your budget. Regularly reviewing and adjusting your budget ensures that it remains effective in helping you meet your goals. Set aside time each month or quarter to analyze your spending and check if you're still on track to meet your goals. If you receive a salary increase, a bonus, or an unexpected windfall, consider using that extra money to boost savings or pay off debt. On the other hand, if you encounter financial setbacks, you may need to adjust your budget and spending habits temporarily to stay on track. Explore additional income sources if you find that your budget is too tight or that you're not able to save as much as you'd like. Finding additional sources of income can be a game changer. The more income you generate, the easier it will be to meet your financial goals and create a more flexible budget. Consider side gigs like freelancing, tutoring, or driving for a ride-sharing service. If you have a hobby or skill, you may be able to monetize it by selling products or services online. Additional income sources allow you to pay down debt faster, increase savings, and reach your financial goals more efficiently. A sustainable budget is the cornerstone of financial stability and success. By defining your goals, analyzing your income and expenses, making smart spending decisions, and automating payments, you can create a budget that works for you. Maintaining a budget requires regular adjustments, flexibility, and discipline, but the benefits of financial security, reduced stress, and achieving your goals make it worthwhile. Stay committed, stay focused, and watch your financial health improve over time. The role of emergency funds in financial security. Financial security is a fundamental goal for many, and while there are various paths to achieving it, one key aspect is having a safety net for unexpected situations. This safety net, known as an emergency fund, is a savings buffer designed to cover unexpected costs or life events. Whether it's a medical emergency, job loss, or major home repair, having an emergency fund can be the deciding factor in maintaining financial stability. Without it, people may find themselves relying on credit cards or loans, leading to debt accumulation and further financial stress. The emergency fund plays a significant role in ensuring financial security, making it one of the most vital components of sound money management. Understanding the purpose of an emergency fund. An emergency fund is money that is saved and set aside specifically for unexpected situations. The key characteristic of this fund is that it's not meant for planned expenses like vacations or new gadgets, but rather for life's unexpected hurdles. Emergencies can take many forms: medical issues, sudden car repairs, job loss, or unexpected home repairs. These types of financial setbacks often come at the worst possible time and, without an emergency fund, people would typically turn to loans or credit cards to cover the costs, both of which come with interest charges and can lead to longer-term debt. Building an emergency fund helps individuals manage these unpredictable events without putting their financial future at risk. Having this financial cushion means that individuals don't have to dip into long-term savings or investments, and it provides the ability to cover immediate expenses without resorting to borrowing or increasing credit card debt. Why emergency funds are critical. An emergency fund serves several important purposes that contribute to overall financial security. The ability to cover unexpected costs without financial strain is a crucial element for long-term stability. One of the most significant benefits of an emergency fund is its role in protecting individuals from debt. Without one, people are more likely to rely on credit, accumulating high-interest debt that is difficult to pay off and ultimately destabilizing their financial situation. Having an emergency fund can prevent this cycle, providing a cushion that allows people to handle unforeseen costs without resorting to loans. Furthermore, an emergency fund can provide mental peace and reduce financial stress. Financial anxiety is a common issue, especially in times of uncertainty. The reassurance of having an emergency fund means individuals are less likely to panic when faced with an unexpected expense. Instead of worrying about how to come up with the money, they can simply access their emergency fund to take care of the issue. This peace of mind can be invaluable, not just for emotional well-being but also for maintaining focus and stability in other areas of life. Another key benefit of an emergency fund is that it allows individuals to maintain their long-term financial goals. When an emergency arises and there is no emergency fund to rely on, people may be forced to tap into their retirement savings or other long-term investments. This can delay or derail goals like buying a home, saving for retirement, or paying off student loans. By having a separate emergency fund, individuals can keep their savings for these long-term goals intact while addressing short-term crises with their emergency savings. The importance of preventing debt through an emergency fund. Debt is one of the most common consequences of not having an emergency fund. When an unforeseen situation arises, many people immediately turn to credit cards, personal loans, or even payday loans to cover the cost. While these options may seem like a quick solution, They often come with high interest rates, and the repayment terms can be daunting. The result is that the individual ends up in a cycle of debt, paying off the loan or credit balance for months or even years. An emergency fund is a vital tool in preventing this type of debt. It allows individuals to cover unexpected expenses without the need to borrow money or put themselves further into debt. By having this financial cushion, the temptation to rely on credit cards or loans is reduced, which helps individuals maintain their financial stability and protect their credit score. Avoiding debt through an emergency fund ultimately ensures a healthier financial future. Moreover, relying on credit for emergencies can negatively affect one's credit score, making it more difficult to secure loans in the future. A poor credit score can lead to higher interest rates on mortgages, car loans, and personal loans, further exacerbating financial challenges. An emergency fund shields individuals from this risk by providing a buffer that prevents the need to use credit for emergencies. The role of an emergency fund in financial discipline. Building an emergency fund is not just about saving money. It's also about developing the discipline to set aside funds regularly. Establishing this financial habit early on encourages responsible money management and instills a sense of financial responsibility. While it may be tempting to spend money on immediate desires, having an emergency fund in place forces individuals to think long-term and prioritize their financial well-being. The process of saving for an emergency fund helps to build an awareness of spending patterns, the importance of budgeting, and the value of saving consistently. By practicing financial discipline to build an emergency fund, individuals also prepare themselves for other financial goals, such as saving for a home, paying off debt, or investing for retirement. The skills learned in building an emergency fund carry over into other aspects of financial management, creating a solid foundation for future financial success. In addition, having an emergency fund makes it easier to stick to a budget. Knowing that funds are available for emergencies reduces the urge to overspend in other areas of life. It also helps prevent the need for lifestyle inflation, where individuals increase their spending as their income grows. Instead, the focus remains on living within one's means and saving for future needs. How to build and manage your emergency fund. Creating an emergency fund doesn't happen overnight. It requires dedication, consistency, and careful planning. One of the first steps in building an emergency fund is to determine how much money you need to save. Financial experts generally recommend saving 3 to 6 months' worth of living expenses. This amount can vary based on individual circumstances, such as dependence, income stability, and lifestyle. Start by setting small, manageable savings goals. Saving $25 a week may not seem like much, but it adds up over time. Gradually increase your contributions as your income grows or as you find ways to reduce discretionary spending. One of the easiest ways to build an emergency fund is to automate the savings process. Set up automatic transfers from your checking account to a separate savings account so that you are consistently saving without needing to think about it. Automation ensures that saving for emergencies becomes a habit rather than a chore. In addition, consider cutting back on non-essential expenses to free up additional funds for your emergency fund. This might involve cooking more meals at home, reducing entertainment costs, or finding cheaper alternatives for services you use regularly. Redirecting money saved from these lifestyle changes into your emergency fund can significantly speed up the process. As your emergency fund grows, it's essential to track your progress regularly. Monitoring your savings ensures that you stay on target and motivated to reach your goal. If your financial situation changes, whether through a salary increase or a change in expenses, be sure to adjust your savings plan accordingly. What should and shouldn't be included in an emergency fund? It's important to have clear guidelines about what constitutes an emergency and what doesn't. The goal of an emergency fund is to provide financial support during unexpected situations. However, it's easy to get carried away and use it for planned expenses. Some expenses are simply not emergencies and should not be paid for with emergency savings. Emergency situations include things like sudden medical bills, urgent car repairs, and unexpected home maintenance costs. These are expenses that cannot be planned for in advance and require immediate attention. On the other hand, planned expenses like vacations, home renovations, and large purchases should not be covered by your emergency fund. By keeping a strict boundary between emergency expenses and non-emergency spending, you ensure that your emergency fund remains intact and available when you truly need it. An emergency fund is a critical tool in achieving financial security. It acts as a buffer between you and life's inevitable surprises, allowing you to weather storms without falling into debt or jeopardizing your long-term financial goals. While building an emergency fund requires discipline and planning, the benefits are immeasurable. It provides peace of mind, protects against debt, and ensures that you can continue working toward your financial aspirations without interruption. Establishing an emergency fund is one of the smartest financial moves you can make, and it is a step toward a stable and secure financial future. How to build wealth through smart investment choices. Building wealth through smart investment choices is a journey that requires a solid understanding of financial principles, patience, and strategic decision-making. The key to long-term financial success lies in consistently making informed investment choices and allowing time to work in your favor. Understanding the fundamentals of investing before diving into specific investment strategies, it's crucial to grasp the basic concepts behind investing. Investing essentially involves putting your money into assets that you believe will appreciate over time, generating returns. It differs from saving because it involves taking calculated risks with the potential for higher rewards. To make smart investment choices, it is vital to establish clear financial goals. Determine what you are investing for, whether it's retirement, purchasing a home, funding education, or something else. Your objectives will guide your decisions, including how much risk you are willing to take, the time horizon for your investments, and the types of investments that are most appropriate for your goals. The power of diversification. Diversification is a fundamental principle of sound investing. It involves spreading your investments across a variety of asset classes, stocks, bonds, real estate, and alternative investments like commodities or cryptocurrencies, to reduce risk. The idea is to avoid putting all of your eggs in one basket. A well-diversified portfolio allows you to smooth out the highs and lows that come with market volatility. For example, while stocks may perform well in a bullish market, other assets like bonds or real estate might provide more stability during downturns. By balancing different investments, you ensure that a downturn in one asset class doesn't severely impact your entire portfolio. Diversification isn't just about choosing different asset classes. You should also diversify within each class. If you're investing in stocks, consider spreading your investments across various industries, countries, and company sizes. This reduces the impact of sector-specific risks and gives you exposure to multiple growth opportunities. The more diversified your investments, the lower the likelihood that poor performance in one area will undermine your overall wealth-building strategy. Harnessing the benefits of compound interest. One of the most effective ways to build wealth through investments is by leveraging the power of compound interest. Compound interest occurs when your investment not only earns returns on the original amount you invested but also generates returns on the interest or dividends you have already earned. This process results in exponential growth over time. The key to benefiting from compound interest is time. The earlier you start investing, the more you can take advantage of compounding. Even if you start with a small amount, consistent contributions to your investment over time will result in significant growth. For example, investing in a retirement account and allowing your interest to compound for decades can result in a large nest egg by the time you retire. In addition to time, reinvesting your dividends and interest payments is crucial. Instead of cashing out your earnings, reinvesting them back into your portfolio allows you to keep the compounding effect working in your favor. This is especially powerful in long-term investments such as stocks or bonds, where the compounding effect can snowball over time, significantly boosting your wealth. Focusing on long-term financial goals. Successful investors understand that building wealth is not a sprint, it's a marathon. Short-term market fluctuations are common, and attempting to time the market by buying and selling based on short-term trends is not a reliable way to build wealth. Instead, focusing on long-term goals helps you stay the course even when markets are volatile. Long-term investing allows you to benefit from the overall upward trajectory of the financial markets. Historically, despite periods of economic downturns and market crashes, the stock market has trended upwards over the long run. Patience and discipline are vital when taking a long-term approach, as the power of compounding and market growth will eventually reward those who stay invested. One way to implement a long-term investment strategy is by focusing on index funds and mutual funds. These funds track the performance of broader market indices, providing a diversified portfolio that mirrors the market as a whole. They offer built-in diversification and are particularly useful for individuals who do not have the time or expertise to pick individual stocks. Exploring the potential of real estate remains one of the most reliable ways to build long-term wealth. Investing in property can provide both income through rental yields and the potential for capital appreciation as property values increase. Real estate can also be a hedge against inflation, as rents and property values tend to rise when inflation is high. You don't have to buy physical properties to invest in real estate. Real estate investment trusts, REITs, provide an opportunity for smaller investors to gain exposure to the real estate market. REITs pool money from multiple investors to purchase and manage income-generating properties, such as commercial buildings, residential complexes, and retail spaces. This allows you to benefit from real estate investments without the need to manage properties yourself. In addition to REITs, investing in residential or commercial properties directly can generate a consistent income stream through rents, providing a stable source of cash flow. However, this type of investment does come with its own set of challenges, including property management, maintenance costs, and potential vacancies. Weighing these factors carefully will help you decide whether direct property ownership or a more passive approach like REITs is right for you. Smart stock market investments. The stock market is another essential avenue for building wealth. While investing in stocks comes with higher risk, it also offers higher potential returns compared to more traditional investments like bonds. The key to success in the stock market is choosing stocks that have strong growth potential. When selecting stocks, focus on companies that demonstrate strong financial health, robust earnings growth, and a competitive advantage in their respective industries. Emerging sectors such as technology, healthcare, and renewable energy present excellent growth opportunities, as these industries are expected to continue expanding in the coming years. For those who prefer a more hands-off approach to stock investing, exchange-traded funds, ETFs, offer a practical solution. ETFs are similar to mutual funds but are traded like individual stocks. They provide an easy way to diversify within the stock market, offering exposure to entire sectors or markets without the need to pick individual stocks. Many ETFs track the performance of major stock indices, allowing you to invest in a broad range of stocks with a single investment. Automating your investments for consistency. One of the simplest ways to ensure that you are consistently building wealth is to automate your investments. Automating your contributions to investment accounts, such as retirement accounts, brokerage accounts, or even a high-yield savings account, helps you stay on track with your financial goals. Automatic contributions take the decision-making process out of your hands, ensuring that you continue to invest regularly, even if you're busy or distracted by other financial priorities. This strategy also helps you avoid the temptation to time the market or make emotional decisions based on short-term market movements. Many employers offer automated 401k contributions, where a portion of your paycheck is automatically deposited into your retirement account. By setting up automatic contributions to your investment accounts, you are more likely to reach your long-term financial goals while making investing a regular part of your financial routine. Minimizing fees and taxes to maximize returns. Minimizing fees and taxes is crucial to growing your wealth. High fees can eat into your returns, especially over the long term. When selecting investment products, consider the fees involved and how they will impact your overall returns. Low-cost index funds and ETFs tend to have lower fees compared to actively managed funds. These funds passively track a market index, making them more affordable while still offering broad diversification. When it comes to taxes, utilizing tax-advantaged accounts such as IRAs or 401ks allows you to invest without worrying about immediate tax consequences. Tax-efficient strategies, such as tax loss harvesting, can help reduce your taxable gains, further preserving your wealth. Regularly reviewing and adjusting your investment strategy. Building wealth through investing is an ongoing process, and it's essential to regularly review your portfolio to ensure it aligns with your current financial goals and risk tolerance. Life changes, such as marriage, having children, or changing careers, may affect your investment strategy, necessitating adjustments to your asset allocation. Even if your life circumstances remain the same, Periodically reviewing your portfolio helps you assess whether your investments are performing as expected. Make adjustments when necessary, whether it's rebalancing your portfolio or shifting your focus to new growth areas. Building wealth through smart investment choices takes time, strategy, and a disciplined approach. By diversifying your investments, taking advantage of compound interest, staying focused on long-term goals, and continuously reviewing your strategy, you can steadily grow your wealth over time. Investing isn't about instant gratification. It's about making informed decisions today that will pay off in the future. With patience, consistency, and careful planning, smart investing can pave the way to a prosperous financial future. The journey to debt-free living. Practical tips and techniques. Achieving a debt-free life is a goal many people dream of, but few know how to make it a reality. The journey to becoming debt-free involves discipline, strategy, and perseverance. While it may seem overwhelming at first, breaking down the process into manageable steps can lead to financial freedom and peace of mind. Acknowledge and assess your debt. Before you can take control of your finances, you need to face the reality of your situation. The first step in the journey to becoming debt-free is to acknowledge and assess your debt. It's essential to have a clear understanding of how much you owe, to whom, and at what interest rates. Start by gathering all your statements, credit card bills, student loans, personal loans, and any other forms of debt. Make a list of each debt, including the total amount owed, the interest rate, the monthly payment, and the minimum payment required. This will give you a comprehensive view of your financial obligations and help you strategize how to tackle them. The key to overcoming debt is understanding your debt landscape. Once you've listed everything, you'll have a clearer idea of which debts need immediate attention and which ones can be tackled later. This process might feel uncomfortable, but it's a crucial first step in the journey to financial freedom. Create a budget. The next crucial step in your journey to debt-free living is to create a budget. A well-structured budget helps you manage your income, expenses, and savings more effectively. It allows you to allocate a portion of your income toward paying down your debt while ensuring that you meet your essential living expenses. Start by tracking your income, listing all sources such as your primary job, freelance work, or any other streams of revenue. Next, identify your expenses, categorizing them into essential and non-essential expenses. Essential expenses include rent or mortgage, utilities, groceries, transportation, and healthcare, while non-essential expenses include things like entertainment, dining out, and shopping. The next step is to set spending limits for each category and commit to living within those boundaries. Prioritize debt payments as one of the first items on your budget to ensure you are consistently working toward debt repayment. Living by a budget is a critical tool for financial success. With a clear plan, you can avoid overspending, curb unnecessary habits, and allocate extra funds toward paying down your debt faster. Build an emergency fund. While it might seem counterintuitive to save money while you're in debt, building an emergency fund is a crucial part of becoming debt-free. An emergency fund acts as a safety net, so you don't have to rely on credit cards or loans when unexpected expenses arise. Start by setting a small target for your emergency fund, ideally $500 to $1,000. Once you've reached that goal, you can focus more on paying down debt. Having this cushion will protect you from further financial strain in case of emergencies such as car repairs, medical bills, or unexpected job loss. The key here is not to neglect saving for emergencies, even while paying off your debt. By having an emergency fund in place, you can avoid taking on additional debt when life throws curveballs. Choose a debt repayment strategy. There are several strategies for paying down debt, and the right one depends on your individual situation. Here are 3 popular methods that can guide you toward becoming debt-free. The debt snowball method involves paying off your smallest debt first, regardless of the interest rate. Once that debt is paid off, you move on to the next smallest debt, and so on. The idea behind this method is that paying off smaller debts quickly provides a sense of accomplishment and motivation, which can keep you going as you tackle larger debts. While this method may not save as much money on interest, it can be helpful for people who need quick wins to stay motivated. Alternatively, the debt avalanche method focuses on paying off the debt with the highest interest rate first. This method saves you more money in interest over time but may take longer to see progress. Once the high-interest debt is paid off, you move on to the next highest rate. If you're financially focused and want to minimize interest payments, this method is a solid option. Another strategy is debt consolidation, which might be suitable if you have multiple high-interest debts. Debt consolidation involves combining all your debts into a single loan with a lower interest rate. This approach simplifies your payments, as you'll only need to focus on one payment, and can save you money in the long run. Choose the strategy that works best for you, and commit to sticking with it. Consistency is key, and no matter which method you use, the goal is to pay off your debts as quickly as possible while maintaining a balanced financial life. Cut back on unnecessary spending to accelerate your journey to becoming debt-free. You need to make sacrifices and cut back on unnecessary spending. This doesn't mean depriving yourself of all pleasures, but rather being mindful of where your money is going. Start by reviewing your spending habits. Can you cut back on dining out, entertainment, or other discretionary expenses? Small changes in your spending habits can free up a significant amount of money that can be directed toward debt repayment. For example, cooking meals at home instead of ordering takeout, or finding alternative ways to enjoy entertainment, such as using streaming services instead of going to the movies, can make a noticeable difference. Another area to consider is subscription services. Review all your recurring subscriptions, magazines, streaming platforms, fitness memberships, and determine which ones you truly need. If you can cut out even a few unnecessary services, you will have more money to put toward eliminating your debt. By making conscious spending choices, you create more opportunities to save, pay down debt, and ultimately live debt-free. Increase your income while reducing expenses is essential. Increasing your income can significantly speed up your debt repayment process. Look for ways to boost your earning potential, which could include taking on extra work, selling items you no longer need, or exploring side hustles. Consider freelance work, consulting, tutoring, or pet sitting as possible side gigs that could provide you with extra cash. You could also sell unused items, such as old electronics, furniture, or clothing, to generate additional funds. If you're in a position to do so, you might also consider asking for a raise at your current job or seeking higher paying opportunities. Another idea is to monetize a hobby. If you have skills in photography, graphic design, writing, or music, there are platforms where you can offer services and start generating income. The key is to take advantage of any opportunity to bring in extra money and dedicate it to paying off your debt. Increasing your income will help you tackle debt more effectively, reducing the overall time it takes to reach your goal of debt-free living. Stay consistent and stay motivated. The journey to debt-free living is not an easy one. It takes time, effort, and sacrifice, but staying consistent and motivated is key to success. It's essential to remind yourself why you're on this journey, whether it's to achieve financial freedom, reduce stress, or work toward a brighter financial future. Along the way, celebrate small victories. Each debt you pay off is a step closer to your goal. These milestones provide motivation and help maintain a positive mindset. Whether it's crossing off a credit card balance or eliminating a loan, recognizing your achievements will keep you focused on your bigger goal. Remember, consistency is more important than perfection. Life will sometimes get in the way, and it's okay to face setbacks. What matters most is that you keep pushing forward, even on difficult days. Avoid falling back into debt. Once you've paid off your debt, it's important to stay disciplined and avoid falling back into debt. Maintaining financial freedom requires vigilance. One of the key ways to avoid falling into debt again is by sticking to a budget and ensuring you continue living within your means. Consider using cash or a debit card for everyday purchases to avoid the temptation of credit card spending. By sticking to a cash-based system, you'll be more conscious of your spending habits. It's also important to keep building your emergency fund. As your finances improve, aim to increase your emergency savings to cover several months' worth of living expenses. This cushion will protect you from having to rely on credit cards or loans in the event of unexpected expenses. Lastly, set new financial goals. Now that you're debt-free, focus on saving for retirement, investing, or other financial milestones. These goals will help you maintain the discipline you've developed while continuing to build wealth for the future. The journey to debt-free living may seem daunting at first, but with the right strategies and mindset, it is entirely achievable. By assessing your debt, creating a budget, building an emergency fund, and staying consistent, you can make significant strides toward financial freedom. The journey will require patience, discipline, and sacrifices, but the rewards are worth it. Take control of your finances today and start your path to a debt-free future. Retirement planning for long-term financial independence. Retirement planning is often viewed as one of the most important financial decisions in one's life. Achieving long-term financial independence is a journey that requires deliberate thought, strategic moves, and the discipline to stay on course. Today, with the decline of traditional pension plans and the growing uncertainty in the economy, individuals must take the initiative to secure their financial futures. A solid retirement plan can empower you to retire with confidence, free from financial worries, and capable of living the lifestyle you've always dreamed of. Why retirement planning is crucial. Planning for retirement isn't just about saving a portion of your income for the future, it's about creating a life of financial independence. In the past, many relied on Social Security or employer-sponsored pension programs as their primary means of support during retirement. However, these safety nets are becoming less reliable, and in some cases, they may not provide enough for a comfortable life. The reality is that without proactive planning, your financial future could be compromised. It is essential to take control early on to ensure that you can retire with financial security and peace of mind. Set clear financial goals. The foundation of any effective retirement plan is a clear and realistic set of financial goals. Without a roadmap, your retirement savings may lack direction, making it harder to accumulate the necessary funds. Begin by asking yourself the following questions. How much money do I need to maintain my desired lifestyle during retirement? What age do I plan to retire? Do I want to travel the world, start a new business, or simply enjoy more time with family? These questions will serve as the cornerstone of your financial strategy. Once you have an understanding of your retirement aspirations, you can begin estimating how much money you will need to generate monthly income, pay for healthcare, travel, and cover unforeseen expenses. From there, you can calculate how much to save each year, taking into account factors like inflation and possible future changes in your living expenses. Start saving and investing early. Time is one of your greatest allies when it comes to building wealth for retirement. The earlier you start saving and investing, the greater your potential for compounding your money. Compound interest works by earning returns on both your initial investment and any accumulated interest over time. The longer your money is invested, the more it can grow exponentially. Starting early doesn't always mean saving large amounts immediately. Even small contributions early on can lead to significant growth over time. For those in their 20s and 30s, now is the best time to begin. Although you may not have much extra cash, taking even a small percentage of your income and investing it in a retirement fund or high-yield account can make a huge difference in the long run. If you are in your 40s or 50s, it is still not too late to make adjustments. You may need to make larger contributions, but by re-evaluating your budget and prioritizing long-term financial security, you can still build a solid foundation for retirement. Diversify your investments. An essential aspect of retirement planning is managing risk through diversification. Diversification means spreading your investments across various asset classes, such as stocks, bonds, real estate, and mutual funds, to reduce risk and increase the potential for returns. Relying solely on one type of investment can expose you to significant risk, especially during market fluctuations. A well-diversified portfolio helps protect your wealth and provides you with a better chance of experiencing steady growth over time. The risk appetite of each individual varies, so consider your personal situation when creating your investment strategy. If you're younger, you might be more inclined to invest in higher-risk assets such as stocks or tech startups, which can yield higher returns but carry greater volatility. On the other hand, if you're closer to retirement age, you may want to allocate more of your funds into stable, lower-risk investments such as bonds or dividend-paying stocks. Take advantage of tax-advantaged accounts. Tax-advantaged accounts are a powerful tool in retirement planning because they allow your investments to grow without being taxed immediately, giving you the opportunity to accumulate more wealth over time. In the United States, retirement accounts such as 401ks and IRAs offer significant tax advantages. With a 401k, you can contribute pre-tax dollars, which lowers your taxable income for the year. In addition, Many employers offer matching contributions, essentially providing free money to help grow your retirement fund. Roth IRAs, in contrast, allow for tax-free growth and tax-free withdrawals during retirement. Although the contribution limits are lower than those of a traditional 401k, the tax benefits can be substantial, especially if you anticipate being in a higher tax bracket when you retire. Taking full advantage of these accounts can be one of the most effective ways to maximize your retirement savings. Automate your savings. Consistency is key to successful retirement planning, and one of the best ways to ensure consistency is through automation. Setting up automatic transfers from your paycheck or checking account to your retirement savings account ensures that you are regularly contributing to your future. Automation removes the temptation to spend the money elsewhere, and it makes saving effortless. The amount you can contribute each month may vary, depending on your financial situation, but having automatic deductions ensures that you are always saving for the future, no matter what. By doing so, your retirement contributions become a habit rather than something you have to actively think about. Over time, this regular commitment to saving can make a huge difference in reaching your long-term financial goals. Minimize debt and expenses. While it's essential to save and invest, it's equally important to minimize debt and reduce your expenses. The higher your level of consumer debt, especially high-interest debts like credit card balances, the harder it will be to save for retirement. Prioritize paying off high-interest debt as quickly as possible. Once you are free of high-interest debt, you can redirect that money into retirement savings. Take the time to review your monthly expenses and look for areas where you can cut back. Whether it's eating out less, canceling unused subscriptions, or renegotiating your mortgage, eliminating unnecessary expenses will free up more money to invest in your future. The less money you spend on things you don't need, the more you can contribute to your retirement. Plan for healthcare costs. Healthcare costs are often one of the largest unexpected expenses in retirement, especially as you age. It's crucial to account for medical expenses when planning for retirement, as they can quickly add up. Many people assume that Medicare will cover all their healthcare costs, but the reality is that Medicare doesn't cover everything, and out-of-pocket medical expenses can still be significant. To address this, consider contributing to a health savings account, HSA, if you are eligible. An HSA allows you to save money tax-free for medical expenses. Additionally, long-term care insurance can be another wise investment, helping to cover the costs of nursing homes, assisted living, or in-home care if needed. Monitor your progress. Your retirement plan is not something that can be set and forgotten. It's essential to regularly track your progress and make adjustments as needed. Life circumstances can change, and your retirement goals may evolve over time. Whether it's a change in your income, an unexpected expense, or an opportunity for greater savings, it's important to assess your plan periodically. Review your investments, check your portfolio's performance, and evaluate whether you are on track to meet your retirement goals. If necessary, make adjustments to your strategy, whether that means increasing your contributions or rebalancing your asset allocation. Working with a financial advisor can help ensure you stay on track and that your plan remains aligned with your objectives. Planning for long-term financial independence and retirement is a complex but rewarding journey. By starting early, setting clear financial goals, diversifying your investments, and taking advantage of tax-advantaged retirement accounts, you can create a robust plan that supports your future. While it may seem daunting at first, with discipline, consistency, and regular monitoring, you can secure your financial freedom and enjoy a comfortable and stress-free retirement. Remember that the path to financial independence requires patience and commitment, but the payoff is a life of security, fulfillment, and choice in your later years. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts. And I'll see you in the next one.